Top of the afternoon, as the case may be right now. I want to do a quick video on modern portfolio theory and the efficient frontier. This is the stuff I'm the most excited about. When I first saw this, the light bulb went on and I was like, oh my goodness, this is so cool. And this is at the heart of everything I do in here. So I will explain to you in a couple minutes how modern portfolio theory works in essentially 3 graphs. But before we get into that, a quick disclaimer, remind everybody this is for entertainment and educational purposes only. And with that, let's get into it. Modern portfolio theory 101. So modern portfolio theory is a momentum theory, and it assumes that past performance is similar to future performance. And this is the single biggest concern about this theory, and I'll address this in another video and show you how portfolio management addresses that one concern about this theory. The efficient frontier is best explained to you by a demo. So let me pull up a live chart portfolio visualizer. I am on the efficient frontier tool, and I have loaded Apple and BNDX in here, 2016 to 2026. I go view, and up pulls an efficient frontier. And the efficient frontier, it's get a little complicated if there's more than 2, but there's 2, it's really simple. At the top, this is 100% Apple. So this says Apple alone will make 27% return with a 27% standard deviation. And then as you tick down, I believe there's probably 100 or more ticks. You can see that as we get down to like 85% Apple, 12% bonds, what do you expect, all the way down. So we can see if we mix Apple alone and BNDX to make like a 5% return, you're going to need 12% Apple and 88% bonds, and that will have an expected return of 5 with a standard deviation of 5. So, and this is how you mix one asset with another, and depending on the mix. Now, if we let's add a third asset to the mix, just for grins, let's add Costco. I don't know if Costco's a good one. Yes, we can see the efficient frontier is scooted over a bit. It's no longer 100 counting down to 0. This is going to count down. This is figuring out the optimum of the 3, which is the most optimum, which is the combination that produces the highest return and the lowest standard deviation. So mixing Costco in has shifted it to the left, and you can see the efficient frontier now to make 5%. There's a mix of 7% Apple, 85% bonds, and 8% Costco. And so that is the efficient frontier in a nutshell. On the previous chart, we saw Apple at the top of the efficient frontier. Apple over the last 10 years returned an average of 27.19% with a standard deviation of 28%. We can plot those returns on a normal distribution, and we can figure out the spread of the returns and get a feel for how much it's going up and down. And that'll give us a feel for the risk. So if we take all those returns and calculate the standard deviation, we can see that above minus 2 sigma, so down here, up from here all the way over, above minus 2 sigma is 97.72% of the data. I'll sometimes refer to this as just 90% of the data is above minus 2 sigma, just as a broad statement. We can use this minus 2 sigma calculation to get a feel for risk. Let me show you how that's done. So if we take Apple will return 97% of the time, assuming that past data is representative of future data, and that assuming the distribution is a normal distribution, 97% of the time, Apple will produce annual returns that are greater than minus 29%. So this is your risk. So in any one year, there is a 3% chance that Apple's going to drop 29%. Now, this 3% does happen. Not every year, but every once in a while it happens. So if you're not comfortable with that kind of risk, we need to do something to the portfolio to reduce the risk. And what we do is we mix in bonds, we mix in other things that go the other way, and that will bring that number up. We'll make it less negative. And so the math here is the minus 2 sigma is the 27.19 minus 2 times that standard deviation. That gives us our minus 2 sigma, and this is what we'll be referring to when we look at the bottom side risk. So most of the time, we expect the return of this portfolio to be above minus 29%. 50-50, we're going to produce an average rate of 15%. So our return is going to be 15%. And our minus 2 sigma comes up to minus 17. Again, we're looking at the efficient frontier. We've gone 50-50. And we've got this 1511 minus 2 times 15.76 gives us a minus 17%. So there are years where it's possible that we're going to lose 17% of our portfolio value. All right, so let's mix in Sienna and Old Republic Corp. Seeing as a tech company, Old Republic is insurance, and we can see the efficient frontier has scooted to the left. So again, at the same 15%, our standard deviation has dropped to 1183. Now, 97% of the time, we're still going to make that 15%, but our minus 2 sigma number, 15 minus 2 times 11, is minus 8.3. So this is way more palatable at the exact same return rate than the previous portfolio. This is where the mix of the portfolio matters. When I say the portfolio matters, this is what I'm talking about. You want to have a mix so that on the downside, the risk is mitigated. You still want to be able to sleep at night. Now let's see if we can improve this some more. Let's take this same portfolio and we're going to add in a couple of things that are moving in the opposite direction. In this case, we're going to add in Merck, we're going to add in gold, and we're going to add in a floating rate bond fund. Adding in these three things, 11% Apple, 12% Old Republic, 11% Sienna, 14% Merck, 10% gold, and 20% of this different bond fund. This is a short-term treasury rate bond fund. And we've now moved that minus 2 sigma to minus 4.5. So now you can see we have made a portfolio, quote, portfolio, that is less risky, with still making the exact same 15% return on the portfolio. Again, this is all based on historical data, and we're making the bold assumption that history will repeat itself. Now, one note, we're not done. This is not a good portfolio. Why is it not a good portfolio? There's too much concentration in holdings, and we have not checked sector diversification, global diversification, and several other things. Now, there's another video where I'm going to pick up where this left off and convert this portfolio, which is a good start, into a really good portfolio. So modern portfolio, in summary, by mixing holdings that are not correlated, they do not move the same, you can produce good returns at lower risk. Good returns at lower risk. That is what we want to do. We want to try to make returns that just go up. Now, it's not possible just to go up, but we can make that downside a little less by mixing in things that yang when everything else yangs. So that's modern portfolio theory in a nutshell. 3 simple graphs. The main idea is you can mix in things into your portfolio that move opposite the main investments, and it makes the downside risk less. And with that, quick view, and I will bid everybody adieu.